All right, let's get right into it today. We're going to be taking a deep dive into the world of high finance to try to demystify two terms that you've probably heard but might not fully understand.
Yeah.
And that is venture capital and private equity.
Okay.
Now, they sound kind of similar.
They do?
But they're actually playing very different games.
Totally.
So maybe to kind of set the stage,
Yeah.
venture capital is all about like fueling these risky, exciting startups with like big dreams.
Big dreams, big ideas.
While private equity kind of steps in when companies need a more experienced hand.
Right. It's like, think of it this way. Venture capital is like scouting for the next LeBron James.
Right.
Straight out of high school.
Oh, okay.
Raw talent, huge potential.
Yeah.
But like, no guarantee they'll become a superstar, right?
Right.
Private equity, on the other hand, is more like signing a seasoned veteran. Maybe someone who's been bouncing around a few teams, but still has, the talent to win a championship if they have the right coach, the right structure in place.
Oh, I love that analogy. Okay. So let's break it down. Let's start with venture capital.
Yeah.
What exactly are VCs looking for when they decide to invest in a company?
They're essentially betting on the future.
Okay.
They look for startups. These are young companies that have really disruptive ideas that could revolutionize an industry. Think like early Google, right? Just a couple of Stanford students with a crazy idea for a search engine.
Right.
Or Facebook, a Harvard dropout connecting college kids online.
Yeah.
The key here is massive growth potential, right? Even if the company isn't profitable yet.
So it's like they're trying to find that like diamond in the rough before anybody else sees it.
Yeah. Spotting that game changer.
Yeah. That
could really, shift the landscape of a certain industry.
For VCs know that not every startup is going to become the next Amazon, right?
Exactly. Yeah. And that's why they use what's called a portfolio approach. Imagine a baseball team, right?
Yeah.
You don't expect every batter to hit a home run every time they step up to the plate.
Yeah.
You're hoping for a few big hits to carry the team, right?
Yeah.
VC is similar. They invest in a bunch of companies knowing that some, or most, will probably strike out.
Yeah.
But they only need one or two massive wins.
Got it.
To make the whole portfolio a success.
So it's all about managing risk and maximizing those huge wins.
Boy.
But how does this actually play out? How does like a startup go from an idea on a napkin to a billion-dollar company with the help of VC?
It's a journey.
Okay.
A series of funding rounds.
Okay.
Each tied to very specific milestones. So first you have seed funding.
Okay.
It's like planting a seed.
Yep.
Giving the startup just enough capital to kind of sprout, build a prototype, and test their idea in the real world.
All right, so they've got their seedling sprouting.
Right.
What happens next?
Then if the idea shows promise, they move on to Series A funding. Now, this is where things start to get serious, right?
Okay.
Series A helps them build the actual product, hire a team, and acquire those first crucial customers.
Yeah.
So, think of it as building a foundation for a skyscraper.
All right, Series A.
Yep.
And then is there Series B?
Series B, Series C.
Oh, it keeps going.
Yeah, it keeps going.
Okay.
Each round represents a leap forward, a new level of growth and complexity. So Series B might be about expanding into new markets.
Okay.
Or developing new products.
Gotcha.
Series C could be about gearing up for an IPO.
Right.
That initial public offering where the company goes public on the stock market.
So the VCs are kind of like that scaffolding around that company, providing support.
Support, expertise.
And capital.
At each stage of the construction.
Just live it as that experienced coach, guiding that rookie athlete to reach their full potential.
It's that combination of the money and the expertise, right? Expertise, the mentorship,
That makes it so powerful.
Yeah, the network.
Let's talk about the money for a second.
Okay.
How do VCs actually make a return on their investment? Do they just wait for the company to become profitable?
Not quite.
Yeah.
The ultimate goal for most VCs is what's called an exit.
An exit.
An exit. And there are two main ways this happens.
Okay.
The first, and probably the one that gets all the headlines, is the IPO.
Okay.
The big league.
The IPO.
It's like watching your star athlete make it to the NBA or the NFL, right?
Yeah.
So when a company goes public, its shares are listed on the stock market, and those shares become much more liquid.
Right.
Meaning the VCs can sell their shares to the public.
Yeah.
Hopefully at a much higher price.
Yeah.
Than what they originally paid.
So if they get in early.
Early. And it explodes in value.
Yeah.
the returns can be astronomical.
Yeah, talk about a home run.
A home run, yeah.
But what if the IPO isn't an option?
Well, the other exit strategy is acquisition. Another company, usually a larger one, will just buy the startup outright.
Okay.
And this can be a win-win, right?
Yeah.
The startup gets the resources and the infrastructure of a larger company.
Right.
And the VCs get to cash out their investment, hopefully at a tidy profit.
Like the player got traded to a championship contender.
Exactly.
Still a good outcome.
A good outcome.
Even if it's not like, winning the championship.
Totally.
Okay, so I think I've got a pretty good grasp on venture capital now.
Okay.
Let's turn our attention to private equity. You mentioned earlier it's more like signing a seasoned veteran. What exactly does that look like in the business world?
So private equity steps in when a company's already established.
Okay.
Maybe it's even a household name, but it hit a rough patch, or it needs a strategic shakeup to reach its full potential, right?
Okay.
So it's less about nurturing a sapling and more like grafting branches onto a mature tree.
Oh, okay.
To get better fruit,
Yeah, so they're not starting from scratch. They're looking for those companies that have that solid foundation.
Solid foundation, yeah.
They maybe need like a fresh perspective.
Fresh perspective.
A bit of a makeover?
A makeover, maybe some operational expertise.
Okay.
To really unlock that value.
And unlike VCs, who typically take a minority stake, PE firms often buy a majority stake in the company.
Exactly, which gives them much more control.
Oh, okay.
Over the company's direction and strategy.
So they're not just like advisors.
Right.
They are the new owners.
The new owners, yeah.
Calling the shots.
They're coming in and they're implementing their vision.
That sounds intense.
It can be.
But how do they go about actually acquiring these companies? Do they just show up with a suitcase full of cash and say, we're buying you?
Well, it's a little bit more complex than that.
Okay.
One of the most common tools in their arsenal is what's called a leveraged buyout.
A leveraged buyout.
Or an LBO.
Okay, that sounds a little bit complicated.
It can be, but the basic idea is pretty simple. Imagine you want to buy a fixer-upper house.
Right.
Right?
Yeah.
Has great bones, but it needs some work.
Mm-hmm.
You might not have all the cash on hand.
Right.
So you take out a big loan.
Yeah.
Using the house itself as collateral.
Okay.
Then you fix it up.
Yeah.
You add a new kitchen and bathroom.
Mm-hmm.
Now it's worth twice as much.
Okay.
You sell it.
Yeah.
Pay back the loan.
Mm-hmm.
Pocket a hefty profit.
Okay, so an LBO is kind of like that.
It's kind of like that.
But instead of a house, it's a company.
It's a whole company.
Okay.
Yeah, so PE firms use a combination of their own capital and borrowed money to buy a company. They use the company's assets as collateral.
Got it.
For the loan, hence the term leveraged.
Okay.
It's a high-stakes game, right?
Yeah.
Because debt can magnify both gains and losses.
Right.
But if the PE firm's strategy works and they increase the company's value, the returns can be substantial.
Okay, that makes sense. But what do they actually do with these companies once they've acquired them? Do they just sit back and wait for the profits to roll in?
No, not at all.
Okay.
PE firms are known for being very hands-on.
Okay.
They're actively involved in optimizing operations, cutting costs, improving management, maybe even merging the company with others.
Oh, wow.
In their portfolio.
Okay.
To create a much more powerful entity.
So they're not just financial engineers. They're bringing like a whole new management philosophy.
Yeah, a fresh set of eyes.
Like shaking things up.
Yeah, they're trying to unlock that hidden potential.
It's like they're bringing in a new coach for a team,
Exactly. Like they're analyzing every play, identifying the weaknesses, and coming up with a new game plan to really, maximize performance.
That makes a lot of sense.
Mm-hmm.
But how long do they typically hold on to these companies? Do they eventually sell them off?
Yeah, the goal of a PE firm is to eventually exit their investment.
Oh, okay.
Typically within a time frame of like 3 to 7 years.
Mm-hmm. Oh, wow. Okay.
Yeah.
So they're like working against the clock.
It adds a sense of urgency, right?
Yeah.
Which is quite different than the long-term vision that you see with venture capital.
It's like they're running a sprint and VCs are running a marathon.
Exactly.
So what are their exit strategies? Is it the same as VC?
Similar, yeah. They can sell the revamped company to another company.
Okay.
Or they can take it public through an IPO, like VCs.
Gotcha.
The aim is to sell it at a higher valuation than what they initially paid.
Right.
Generating a healthy return for themselves and their investors.
So we've explored both venture capital and private equity in some depth now.
We have.
I think it would be really helpful to summarize
the
key differences between these two investment giants.
I think so, too.
What do you say?
Absolutely. Let's bring it all together and make those distinctions crystal clear.
Great. But before we do that, we're going to take a quick break. Stay tuned, because when we come back, we'll be comparing and contrasting VC and PE to really cement your understanding.
That was good.
We'll be right back. See you in a minute.
Okay.
Okay, so we're back, and we're ready to kind of like draw some clear lines in the sand between venture capital and private equity.
Yeah. Let's make sure we really understand the difference between these two.
All right, so let's start with probably like the most obvious difference, which is the stage of investment.
Right.
VCs are all about those early stage startups.
Right. Exactly.
The companies that are just getting off the ground.
Yeah, they're backing those companies that are still like, figuring things out, testing their ideas, building their team. It's definitely high risk, high reward, but the potential payoff, if they pick the right company, can be enormous.
Whereas private equity comes in a little bit later in the game.
Later, yeah.
When the company's already established, but maybe needs a little bit of a boost.
Yeah, they're targeting companies that have like a proven track record.
Okay.
A solid customer base. They're already generating revenue. Yeah. But they might not be performing, at their full potential.
Okay.
And so they're looking for opportunities to kind of optimize, streamline, and ultimately increase the value of the company.
So it's less about like discovering the next big thing and more about kind of like polishing an existing gem.
Yeah, exactly.
And that difference in the stage of investment, obviously, it plays a huge role in the level of risk involved.
Boy.
VC is like inherently more risky.
Much riskier, yeah.
Because startups are just so unpredictable, right?
You never know which ones will take off.
Yeah.
And which ones will, kind of flame out.
Right. It's like investing in a rookie athlete.
Totally, yeah.
They might have all the talent in the world, but you just don't know if they're going to make it to the pros.
Yep. But the potential reward is also much higher, right? If you invest in the next Google or Facebook, your returns could be just astronomical.
Okay. So higher risk, higher reward with VC.
Exactly.
What about private equity? Would you say it's like a safer bet?
Generally speaking, yeah. I would say it's a little bit safer.
Okay.
Because they're investing in those more mature businesses. But that doesn't mean it's a guaranteed win.
Right.
There's still a lot of work involved
to
kind of turn around a company and make it more profitable.
So lower risk, but probably lower potential returns as well.
Yes. Yeah. Typically the returns for private equity tend to be more predictable.
Okay.
Often in that, 15 to 25% annually.
Okay. So still good.
Very respectable.
Not like, the kind of crazy growth you might see.
Yeah, not the exponential growth.
With a successful startup.
Exactly.
Okay, so I'm starting to see the trade-offs here.
Yeah.
Let's talk about like ownership and control for a sec.
Okay.
You mentioned earlier that PE firms often buy a majority stake in the company.
Right.
How does that compare to VC?
Yeah, that's a key difference. So VCs typically take a minority stake.
Okay.
Meaning they own less than 50% of the company. They have a voice at the table.
Yeah.
They can offer guidance.
Right.
But ultimately, they don't have control.
So it's like being a mentor or an advisor.
Right, exactly.
But not like the head coach. Yeah. Whereas with private equity, it's a different story, right?
It's a whole different ballgame.
They're coming in as the new owner.
The owners, yeah. They're often buying out, the previous founders or majority shareholders.
Okay.
And so that gives them the power.
Yeah.
To make, the big decisions, hire and fire executives, and really reshape the company's strategy.
So it's like a much more, hands-on.
Hands-on active role.
They're not just investing money, they're investing their time, their expertise.
Their network.
To actively try to improve the company.
Yeah, they're rolling up their sleeves. They're getting into the operations.
Yeah.
Working alongside the management team.
Yeah.
To make the company more efficient, more profitable, and ultimately more valuable.
Okay, that makes sense. But how long do they typically hold on to these companies? Do they have an exit strategy like VCs do?
Yes, they do. But the timeline is much shorter than with venture capital. Yeah. PE firms typically aim to exit their investment within like 3 to 7 years.
Wow. Okay.
Yeah, so they kind of have this time frame in mind.
Right.
And they work really aggressively.
Yeah.
To achieve their goals within that window.
So like they're running a sprint, not a marathon.
A sprint, exactly.
They have to make an impact.
A big impact.
In a short amount of time.
Exactly.
What are their exit strategies? Are they the same as VC?
Similar, yeah. So they can sell the revamped company to another company, often a competitor, or maybe just a larger player in the industry.
Gotcha.
Or they can take it public through an IPO.
Right.
Just like VCs do.
Yeah.
But because their time frame is shorter, they have to be very strategic and make sure that they're maximizing that company's value before they exit.
Okay, so it's all about timing and execution.
Timing, execution, strategy.
Okay, so we've covered a lot of ground here.
A lot of ground.
We've talked about like the stage of investment, the risk and reward, the ownership structure, and the typical investment time frame. I think it'd be really helpful to like summarize these key differences for our listeners.
Totally. I think a clear summary can really help solidify these distinctions.
Okay, perfect. Let's do that now.
Okay, so
we will also post like a visual breakdown of these key differences on our website.
Yeah, that's a great idea.
For everyone to check out.
Awesome.
Okay, so first up is like the stage of investment.
Right.
Venture capital. They target early stage startups.
Yeah.
with like disruptive ideas and massive growth potential. While private equity focuses on more mature, established companies that are already generating revenue but might not be performing, at their full potential.
Exactly.
All right, then we have risk and reward. Venture capital is all about like embracing that high risk in pursuit of those potentially massive returns.
Those home runs.
Home runs, whereas private equity is aiming for more moderate, predictable return.
Yep, more consistent.
With a lower level of risk.
Exactly. It's like hitting those singles and doubles. Right?
Exactly. All right, next we have ownership structure.
Right.
Venture capitalists, they typically hold a minority stake. In the companies they invest in, they're kind of acting like advisors and mentors.
Mentors, yeah.
While private equity firms, they often acquire that controlling interest, giving them the power to, make those major decisions.
Yeah. To reshape that strategy.
Reshape the strategy. Yeah. Okay, and then finally we have the investment time frame.
Okay.
Venture capitalists often have that long-term outlook. They're holding on to their investments for, 5, 10, or even more years.
Right.
Patiently waiting for that company to mature.
Right.
And reach its full potential.
It's a long game.
It's a long game. While private equity firms, they typically aim to exit their investments.
Much shorter time frame.
In a shorter time frame, usually 3 to 7 years.
Exactly.
And they're working aggressively to like maximize that company's value before they sell.
Before they sell, yep.
Okay, so those are the key differences between venture capital and private equity, laid out nice and clear.
Nice and clear.
Now that we've demystified these two like investment powerhouses.
Yeah.
Let's shift gears a little bit and explore how you, our listeners,
this is exciting,
can potentially get involved in these really exciting worlds.
I like this part.
Let's empower our listeners to become players in the game.
Yeah.
Not just spectators on the sidelines, right?
Yeah, I love that.
So let's start with venture capital.
Okay.
I know it can seem like this like really exclusive club, right?
Yeah.
It's reserved for those with like deep pockets and insider connections.
Why?
But is there actually a way for the average person to get in on the action?
There certainly is.
Really?
Yeah, and it's easier than you might think.
Okay.
The rise of these crowdfunding platforms has really democratized access to venture capital.
Okay.
In a way that was unimaginable, just a few years ago.
So crowdfunding for startups.
For startups, yeah.
Tell me more about this.
Yeah, so essentially, these platforms allow individuals to, pool their resources and invest smaller amounts in promising startups, often alongside seasoned VCs.
So instead of needing, millions of dollars to play the game, you can participate with a much smaller investment.
Much smaller investment, yeah. So it's a great way
That's amazing.
To diversify your portfolio and potentially get involved in the next big thing.
But it's important to remember that it's still risky, right?
Yeah, it's still risky.
Don't bet the farm on any single startup.
Exactly.
No.
But it's a great way to dip your toes in the water, learn about different industries, learn about innovative companies, and yeah.
And a lot of these platforms also provide, educational resources.
Right, they have a lot of due diligence tools.
To kind of help you make those informed decisions.
Exactly.
Okay, so crowdfunding sounds like a really great option.
Yeah.
For those who are looking to kind of explore the world of venture capital.
Yeah, dip their toes in.
Without needing a fortune to get started.
Exactly.
What about private equity? Is that something that, the average person can get involved with as well?
So private equity is a little bit more complex.
Okay.
It typically requires a higher level of capital and expertise. So it's not as easy as like, signing up on a crowdfunding platform.
Right.
PE investments are often structured as like limited partnerships, which are typically available to, what are called accredited investors.
Gotcha.
Or institutions with significant assets under management.
So it's a little bit more of an exclusive club.
It can be, yeah.
But are there any options for like individuals who are like intrigued by private equity, but maybe don't have, millions to invest?
There are some emerging platforms and funds that are starting to offer more accessible ways for individuals to participate in PE investments. It's still a developing area, but it's definitely worth exploring if you're interested.
That's good to know. And obviously, if you're like interested in pursuing a career in private equity, there are many resources available.
Many resources,
to kind of help you gain the necessary knowledge and experience.
Absolutely.
Great point. So whether you're looking to like invest in the next unicorn startup,
right,
or, help to revitalize an established company,
help turn it around,
there are ways to get involved in the world of venture capital and private equity.
There are, and remember, these fields are constantly evolving.
Right.
So, staying informed and connected is really key.
Yeah, absolutely. Well, folks, we've reached the end of our deep dive into venture capital and private equity.
I feel like I learned a lot.
I hope you found this journey enlightening.
Yeah.
Maybe even a bit inspiring.
A bit inspiring, yeah.
Now we want to leave you with a final thought-provoking question.
Ooh, I like these.
If you had the opportunity to invest in either a promising startup with a groundbreaking idea or a struggling but established company that was ripe for a turnaround,
right,
which would you choose?
That's a tough one. What factors would you consider? I mean, the risk, the reward, the industry, the team behind the company.
Those are the kinds of questions
that investors grapple with every day.
Exactly.
And we encourage you to continue exploring these questions, and delve deeper into the world of venture capital and private equity.
Absolutely. There are countless resources available online, in libraries,
Through professional networks.
Don't be afraid to reach out to people in the field.
Yeah, ask questions.
Learn from the best.
Learn from their experiences. So keep learning, keep exploring, and maybe one day you'll be the one making headlines in the world of high finance.
That would be amazing.
Until next time, happy investing.
Happy investing.
Okay, so we spent the last 2 parts talking all about the ins and outs of venture capital and private equity.
All moving parts.
But now let's get to the part that I know a lot of you have been waiting for.
The fun stuff.
Which is how you can actually get involved in these exciting worlds.
Exactly.
Because I know it can seem intimidating, right?
It can.
Especially when we're talking about these big money deals and high finance.
Yeah.
It feels very Wall Street, very exclusive.
Yeah, definitely not for the average person, right?
Exactly.
But actually, things have changed quite a bit in recent years.
Really?
There are ways for everyday folks to get in on the action.
Okay. Tell me more about this.
Okay, so especially when it comes to venture capital, there's this amazing thing called crowdfunding. Crowdfunding for startups.
For startups, yes.
Okay, this has my attention now.
Yeah, it's exciting.
How does that work?
So basically, imagine this. You and a bunch of other people who are interested all chip in smaller amounts of money.
Okay.
And you pool your resources together to invest in a promising startup.
Okay.
So these platforms, they basically let you be a mini VC. Right?
Oh, okay.
Even if you don't have millions of dollars lying around.
So it's almost like a team effort.
Totally.
Yeah.
It's like a team effort to back the next big thing.
I love that.
It's kind of like, fantasy football, but for startups.
Okay, yeah, I like that analogy. And you get to, be part of something.
And the cool thing is, you often get to invest alongside those seasoned VCs that we were talking about earlier.
Oh, okay.
So you're learning from the pros.
Right.
While potentially getting in early.
Yeah.
On some really groundbreaking company.
But, I can't help but think about the risk here.
Yeah, of course.
Because we talked about how a lot of startups don't actually make it big.
Right, exactly. And that's why diversification is so important.
Okay.
Don't put all your eggs in one basket, right? Spread your investments across multiple startups.
No, kind of like what VCs do with their portfolios.
Exactly.
Okay.
So spread that risk and hope that, a few of them hit it big.
And hopefully those returns will make up for the ones that didn't.
Exactly. Yeah, exactly.
Okay, so crowdfunding sounds like a really great option.
Yeah, it's a great way to get started.
For people who want to kind of dip their toes into that world.
Yeah, if you're curious, if you want to learn more.
Without needing, tons of money to get started.
Without breaking the bank, yeah.
What about private equity? Is that something that's accessible to everyday investors too?
So private equity is a bit trickier.
Okay.
It typically requires a much higher level, of capital.
Right.
And also expertise.
Yeah.
It's often limited to what are called, accredited investors or institutions that have those really deep pockets.
So it's still kind of like a more exclusive club.
It can be, yeah.
Are there any options, though, for individuals who are like really intrigued by private equity, but they don't have, millions to invest?
Yeah. So there are some emerging platforms and funds that are trying to make it a little bit more accessible to everyday investors. But it's still a developing area. So definitely do your research, but there are options out there. That's
good to know.
Yeah.
So there are ways to get involved in both VC and PE, even if you're not, a Wall Street like hotshot.
Exactly. And don't forget about the career side of things too.
Oh, that's a good point.
If you're fascinated by this world,
yeah,
consider exploring career paths in venture capital or private equity.
Okay.
There are tons of resources available to help you, learn what you need to know to break into these fields.
Great point. So whether you want to invest in those companies or work directly with them, there are paths for those who are really passionate about innovation, driving growth.
And remember, these fields are constantly changing.
Right.
So staying curious, staying informed is really key.
Absolutely. Well, that brings us to the end of our deep dive into venture capital and private equity.
This is fun.
It was really fun, and I hope you found this journey insightful and maybe even inspiring, as we always say.
Always inspiring.
Now, before we go, I want to leave you with one final thought.
Okay.
Imagine you had the chance to invest in either like a promising startup with this amazing, groundbreaking idea.
Okay.
Or a struggling but established company that was like really ripe for a turnaround.
Ooh, that's a good one.
Which would you choose?
That's a tough choice.
Yeah.
What would you look at? Would you look at the risk, the reward, the industry, the team?
These are the types of questions that like investors are wrestling with every day.
Every single day. And honestly, there's no right or wrong answer.
Right.
It really depends on your individual circumstances, your risk tolerance, your goals, your passions.
And we encourage you to keep exploring these questions.
Absolutely.
And to really delve deeper into the world of VC and PE.
There are so many resources out there,
Absolutely. Books, websites, online courses.
Professional networks.
Yeah.
Don't be afraid to reach out to people, ask questions.
Yeah, don't be afraid to pick somebody's brain who's actually doing this stuff.
Yeah. Learn from the best.
Learn from the best.
That's how you grow.
So keep learning.
Keep learning.
Keep exploring.
Keep exploring.
And maybe one day you'll be the one making headlines in the world of high finance.
That would be a dream.
All right. That is all the time we have for today, folks.
It went by so fast.
Until next time, happy investing.
Happy investing, everyone.